What is the formula to calculate HDI? Formula to calculate HDI ratio is your PITIA divided by total income. Total income. Now I'm telling you that my income is $10,000. Okay? Borrower in $10,000. Now what is PITI? So let's calculate it. This is the property. Okay, this one is the property, and in the property your principal and interest is $1,600. Taxes is going to be, let's say, $300, and insurance is going to be $100. HOA dues $50. All amounts are always going to remain monthly payment, right? Monthly payment. What is principal and interest? 1,600. Taxes 300. Insurance 100. HOA 50. What is the total?
2050.
$2,050. Now what is my HDI? My HDI is going to be 2,050 divided by 10,000. That is the total income. Now, what is the ratio? Now what is 2050 divided by 10,000 multiplied by 100. Let's multiply by 100. It should be 20.5, right? 2050.
Yes, sir. 20.5.
10,000. 10,000 is going to be 20.5. 20.5% is what my HDI. Now I'm giving you information. Each time whenever you are going to underwrite a file, you are going to check your approval. Your HDI should not be more than 40%. It should not be more than 40. If it is going to be more than 40%, your loan will get, it is not going to be approved. So try to keep this HDI at 40%. Unless there is a FHA loan or VA loan, it can increase to 45, 46% or nearby 50. But I haven't seen any loan that is being approved more than 40%. HDI, only housing payment or mortgage payment or housing expense should not be more than 40. Okay, this is what the HDI only. But then we will see what is the DTI. DTI is total debt to income ratio, or back total debt to income ratio. Now total debt to income ratio, how we are going to calculate total debt? What is my housing mortgage payment? My mortgage payment is, let's say, 205 for this. Then I have one credit card, and balance of that credit card is, you guys need to be with a notepad and a pen or with calculator, but without notepad you won't be able to do all these calculations. And believe me, this is the calculation. If you do not have clarity with calculating your DTI, then you won't be able to underwrite file. Why? Because whatever the calculation you are going to do, whether it's expenses, whether it's your income, you are going to calculate everything, and then you are going to bring it to calculate your DTI. So you calculate borrower's income, and that coming 9,000. Then you calculate all the expenses, and those are coming like 4,500. So now 45 divided by 9,000 is going to be 50% of your total debt to income. And then you need to see what is my HDI, what is my housing payment. And with housing payment, you are going to again calculate, need to see what is the 40% by 45% is my HDI and DT. But 50% or more than, I would say at least 60 to 70% underwriters, they become always confused in the DT, because this is what the conclusion of underwriting. You can learn calculating income, you can learn any other calculations, those are related to expense, but everything need to bring down to this point where you are going to calculate your DTI. If you are not going to calculate DTI correctly, you are going to miss even a one calculation, 1 point. If your DTI is going to be more than 45%, you won't be able to approve the loan. All the calculation of your underwriting will be concluded here in DTI. So please practice as much as you can. Try to, there are going to be different scenario while calculating. Each time we are going to complete the credit, we are going to calculate the DTI. Again, we are going to calculate, we are going to learn the income calculation. Again, we are going to calculate the DTI, right? And the DTI formula or the concept keep changing according to income, according to if you have rental income or if you have rental expenses, your DTI formula is going to change. You need to be very clear where I need to put this amount so that my DTI gets correct. It is not a very simple, right? Calculation. It's not just a divide and multiply. Here is the concept that you need to be very clear. If you have clarity calculating the DTI, you know at least 50% of your underwriting. So please be with the pen. Don't try to skip these calculations. Otherwise, you will always junior underwrite. Okay. So now the credit card balance $5,000 balance, and this is the monthly payment. Monthly payment for this $500. Now there is another. Let's say auto loan. Auto loan means car loan. Auto loan is, let's say 15,000 is what the balance is, and your monthly payment is, let's say 750. And then you have education loan. Education loan is $9,000 and payment is maybe $100. These are the extra additional expense. What is the total monthly? What I told you, DTI will always monthly payment 500, 1250, $1,350. This is your, now you have to, one is your HDI total payment, that is for the property is 2050, and another payment 135. So both you are going to calculate. What is the formula to calculate your DTI, total debt to income ratio? Formula is your HDI, means your mortgage payment, or you can say subject property mortgage payment plus all other debt. Can you give me the total DTI? Property expense, total subject property
3,400,
expense
sir.
2050 plus
Plus
all other expenses are
1350.
1350 divided by 10,000. What is our DTI?
60%.
34 divided by 10,000. It is going to be 34%. Correct? So what is our ratios? Our ratios are going to be like this. HDI 20.5% by 34%. So this is our DTI, total debt to income ratio, and this is our DI front. This is front ratio, only belongs to the property. Only belongs to property, and this is our DTI, total debt to income, means all the debt, property plus all my other debts, my credit card, or what is that? 34% compared to mine. And when it comes to only housing, then it is 20.5%. Am I clear with this? Any doubt? Any question?
Sir, other expenses also it will come, right?
Other expenses?
Will come, right, to calculate DTI?
Yes, total debt to income means, what is the formula to calculate total debt to income ratio? Subject property expense plus all other debt. Okay, so let me show you another example. This is my property. Okay,
I'm trying to ask personal monthly expenses.
Personal monthly expenses, whatever appearing on credit.
Okay.
Okay, we do not calculate utilities like electricity bill, water bill. No, those are not.
Okay.
Right. That is why, why do we approve only, when I say maximum 40 to 50%? Why do we approve this only? Why don't we approve 70% DTI? Means somebody has total expenses of $7,000 and their income is $10,000. Their DTI will become 70%, right? But we don't approve this. Why? Because we think that at least 65% of the income should be for survival, right? To pay their utility bill and for their personal life. So that is why we do not. We are already leaving behind 65% of their income to take care of those expenses. Okay. So this is my subject property, right? I applied loan. My loan amount is 300,000. Interest rate is maybe 6%, right? It's a fixed 30 years loan, right? So now what is going to be my mortgage payment? How do we calculate mortgage payment? Mortgage payment will be simply calculated based on the amortization. 30-year fixed loan, you can go to Excel worksheet or to your software, it will be automatically calculated. So I'm giving you hypothetical amount that our mortgage monthly payment is let's say $1,800. This mortgage payment includes our principal and interest. Then I need to check what are the taxes for this. We are talking about this property. Taxes. Taxes are $300. Then I'm telling insurance. What is the property insurance? Property insurance is $150. HOA, there is no HOA. MI, there is no MI. So we are good. These are the three expenses. What is total? $2,250. Right? These are my payment. What do we call it? This is my loan amount, right? So I'm telling this is my subject property purchase. I'm purchasing this property. So this is the amount that we are going to show here that these are proposed payments. Proposed means if I am applying loan to purchase this property, once I purchase this property, this is $2,250 will be my monthly mortgage payment. But when I will be paying, I will be paying when I will close this loan, when my loan will get closed. So that is why we are calling it proposed. Proposed means in the future, once loan will be closed, I will get the money, I will purchase the property. Post that, maybe my first installment until last installment, this is going to be my monthly mortgage payment. Housing expense, instead of telling how mortgage payment, I would say it's my housing expense per month, right? Total housing expense or proposed housing expense. Let's say I'm living on a rent and per month I'm paying $1,000 as rent. So this is what my current scenario. I'm currently living on rent and 1,000 is my what rent, right? So these are my current expenses, or we can say current housing expense. Currently on today's date, this is what my current expense. This is going to be proposed. If I purchase this property, I take this loan, then in the future, this is going to be my housing expense. As of now, what is my housing? $1,000. That is rent. I'm paying rent. I do not, when I rent out a property, I need not to be worry about taxes or insurance. That is what whoever is the homeowner, he will take care of that. I just need to pay rent. So my total housing expense in the current date is $1,000. But as I applied for a loan, bank is telling me that your proposed housing expense are going to be $2,250, right? My income is $9,000 per month. Per month, $9,000. So this is what is going to be my HDI, housing expense ratio? Are you guys doing it? Housing expense ratio is going to be housing expense, total housing expense are $2,250, right? Total income is dollar. What is my total? $9,000. Now tell me what is the HDI, front ratio. What is the front ratio?
23.19.
23.19%. Okay, let me check. 2250 divided by 9,000.
I calculated the rental income also.
So what is the source? What do you think? What we are doing?
70% I calculated.
Now, what I am telling, rent is $1,000, right? So what
Yes.
we are calculating here? That was my next question. What we are calculating? What I am telling, this is what my current expense is. Okay, listen very carefully. It's a very good actually logic that you need to understand concept. Current expenses are $1,000 in today's, right? This is what my current then here I am telling that when you are going to purchase this property in the future, this is going to be your proposed payment. So when this is going to be when the loan will get closed and I will take the possession of this property. So when I'm going to take the possession in this property means I'm going to live in this property, right? This is my primary purchase. So let's say I'm telling this is going to be your payment. I'm telling, okay, I'm fine because it is just 23.9. I'm good, right? I can pay it easily. Very good. Then on next month, within this month, this loan was closed and I took the possession. So what I did, I moved from this property to this property. Yes or no?
Yes, sir.
Right? I moved to this property. So am I still supposed to pay the rent in future?
No, sir.
No, right? Because I will be moving to this property. So when I'm going to move this property, I will vacate, I need not to pay rent. So if I will not be paying the rent. So should we include this also here in the expense? It is not going to be in the future. We are talking about, we are calculating the future expenses. That when you going to chase your property, obviously you are going to leave the rental house, right? You will move to your own property. Now you will live here. So you will say, now I need not to pay the rent. I will pay my mortgage. So that means this will be ended. There is no rental payment. So if it is not going to be there, why we need to worry about? We cannot calculate this. It is not in the future. Got it?
Yes, sir.
Yes, sir.
Everyone. Nanja,
Yes, sir.
hardly. Rama, clear?
Yes, sir.
Okay. Now let me give you another scenario. This is my property. Okay. I'm living in this property. I'm living in this property. This is my primary home. This is my primary home. Okay. Now in the primary home, there is a loan going. Means this is my primary home. I'm already living right. There is a loan amount that is going on for I'm paying almost principal plus interest, both loan payment, monthly mortgage payment. I'm paying loan payment or mortgage payment. Principal plus interest is $1,500 that I'm paying. Now taxes for this property are 250 and insurance for this home is $100. It's an SFR property, no HOA, no mortgage insurance. So total is now $1,850.
50.
This is what my mortgage payment. I'm paying it every month because I'm already living in this house. Okay, this is my primary residence. Now I want to purchase another property. Okay, and this is going to be my investment. I'm telling I'm buying an investment. I applied same 300,000 loan, right? And my proposed housing expense are going to be principal plus interest. Payment is going to be maybe $2,000, right? It's an investment property. Property taxes are high, and those are $500. Insurance is also slightly high, and that is $200, right? It's in the third property, so there is HOA also. What is the HOA payment? Let's say $100 per. What is the total proposed payment?
2,800.
$2,800. Very nice. My monthly income is dollar. Let's say maybe $6,000. $6,000. Now calculate the HDI for this property. Housing debt to income ratio.